Hi friends, welcome to Behind the Returns. I'm your host Arun and I head the mutual fund research at FundsIndia. As always, we have a super interesting guest with us. We have Aparna Karnik, who's a part of the quantitative research team at the DSP Mutual Fund. Now, in case you're wondering why we have invited somebody from the quantitative research team, she's a person who's instrumental in building the strategy behind DSP Quant Fund. Now, for those of you who are wondering DSP Quant Fund, what is DSP Quant Fund? Now, DSP Quant Fund is essentially a fund which says, I don't need a fund manager. I completely run on rules. So it's a super interesting space which is pretty nascent in India, and we are curious to understand what really goes behind building the strategies and rules for a quant fund. And probably we have the best person to answer that right in front of us. Hi Aparna, welcome to the show.
Hi, warm welcome to you and all the viewers as well.
Sure. So Aparna, can you take us through the genesis of DSP Quant Fund in terms of from where did the idea sprout and how was the first initial how did the initial thought process look like and all the way up to the final product? How did the whole product evolve?
Yeah, no, actually, it's pretty interesting. So we've been following, the factor-based and quantitative or the scientific investment space for many years now. In fact, our former partner, BlackRock, as you know, we were, they were also a joint venture partner couple of years back. So they were also one of the pioneers and the leaders in this space. So we were very keen that we should also offer a similar product to Indian investors, because there was really nothing in the mutual fund space which was which an Indian investor, for example, could invest in. So we were very keen to have a fund in our sort of portfolio which combines, you can say, a sweet spot between both active and passive investing. And we almost took more than 1.5 years, to work through and design the model, which essentially powers this fund. And a lot of research on similar strategies and factors went into the design of this product. So actually, we were working for it almost 1.5 years, 2 years prior to the actual launch, which was in June of 2019.
Right. So Aparna, can there is a 3-step process that you follow to finally construct the portfolio. Can you take us through those 3 steps?
Yeah. So essentially, it's as you rightly said, it follows a 3-step process, the model. The first, so we start with the universe, which is BSE 200, which essentially these are all fairly large or mid-sized companies, liquid, very well covered by the analyst community. So not much information asymmetry or information arbitrage in this space. So what we do is we start with BSE 200, then we eliminate very stringently any companies in this which have very high leverage, like high debt to equity ratios, very high stock price volatility, which also we measure through some quantitative measures. We also remove those companies where our framework throws up accounting related or governance related red flags, and also companies where the ownership, there are some conflicts of interest in the way the sort of ownership and management functions. So after this first step of elimination, almost 80 to 100 companies get removed entirely from the universe. So that leaves us with another 100 odd companies. On this, we apply the second step, which is the selection criteria. So out of the remaining 100 odd companies, we look at 5 factors which essentially span quality, value, and growth investment styles, measured through 5 factors like returns on equity or like dividend yield and so on. So what we do is we rank each of the remaining companies on each of the factors. It's like you're giving an exam of 5 subjects. So then what we do is we look at the average score of each of the companies, remaining companies, on all the 5 factors, and we choose essentially the top 40 to 50 names. which which have the best sort of combination of quality, growth, and value characteristics. So that becomes the second step for the selection. And the third, which is also a very important step, is the portfolio construction. So once we have selected the universe, eliminated and selected, then that's the third step, which is construction. So we apply a very stringent risk constraints to try and have an optimization which will mechanically assign weights, automatically assign weights. I mean, it's not done by any humans, it's done by the model with very strict boundaries. So what the boundaries are essentially is like no stock should be higher than a concentration constraint on absolute and active weight, or in terms of liquidity, no stock should be more than 10x of its weight in its parent index, or the sector overweight and underweight has to be capped at plus or minus 5% of whatever it is in the BSE 200. Group exposure is also capped. So then we apply all these constraints so that we create a very holistic portfolio, which tries to represent best companies within all the sectors essentially of the listed universe in India. So that's how the three-step process of elimination, selection, and portfolio construction works.
Right. Aparna, you were also mentioning about certain factors. So globally, it's seen that there are certain characteristics of stocks where if you go by these characteristics and then in the long run they tend to do well, which is otherwise all the factors. Now there are different factors available, right? So you have particularly chosen a few and you've also eliminated a few. So can you also take us through the thought process of why these factors in particular, and what were the factors which you haven't considered, and any particular reason for that?
Yeah, so there are, as you rightly said, there are several factors, several factor types essentially. Within each factor, you can have multiple descriptors, but there are 5 or 6 typically factors which are. So what the way we went for it is we looked at academic foundations and global experience, because Indian markets, we still don't have more than like 15 years of very rich data. So we looked at factors that are academically proven, or where there are very strong academic foundations, and which have generally worked across geographies, asset classes and time horizons. So within that, we looked at, so we drilled down to about 15, 16 factors, descriptors, and then we tested those in the Indian context. So we tested those individually on the BSE 200 over last 15 odd years, where we could get the data, proper data. And then we reviewed those 15 factors for their ability to generate those additional, whatever, the excess returns in the Indian context. And then, so then finally we chose factors, 5 factors. And what we tried to do was we tried to have factors which encompass, both defensive and cyclical market conditions, and we look at factors across quality, value, and growth, because these are more fundamental investing styles, So, for instance, we chose not to have momentum as a factor, because it requires a lot of churn and changes in the portfolio, and it's more of it's not that fundamental, in that sense. So we went with quality, growth, value, a combination of defensive and cyclical, which we measure by things like how the factor does in the up market versus down market, or what is the correlation between the factors. Ideally you want factors which are not too correlated, otherwise it's not going to help in adding anything into the portfolio. So like that, we chose 2 quality factors. So we have returns on equity and earnings growth stability. Those are our 2 quality factors. On valuations, we saw that PE and PB don't have such strong results in India. So we chose cash flow based value metrics like dividend yield and free cash flow yield. And for growth, we looked at medium term forecasts. So growth projections, basically medium term growth forecast. So these are the 5 factors that we chose, and the reasons why we chose these factors.
Right. So, Aparna, when we usually talk to fund managers, one of the common threads that we have noticed is that almost everybody's process eventually evolves over a period of time. So they do mistakes, and obviously based on different environment, there is a learning into the process. So in that sense, there is no static process or philosophy. So when it comes to the quant fund right now, since the rules are already defined, will these rules remain static across, or will these rules evolve for future improvements and future mistakes?
No, that's a very good question, actually. So that's very true what you said. So while the basic construct will not change, but we also recognize that we have to keep on keeping ourselves on top of factor research. So while the basic framework won't change, but we keep trying to refine our elimination criteria. So for example, our accounting or our forensic red flags, we keep refining those. So those also incorporate refinements over time, so they do evolve. In terms of the factors also, we have in fact, in our offer document itself, we mentioned that we have a model review annually. So what we do is we keep researching, and if for instance we come up with a better, for example, a better value factor, while we not have more than 5, but we may choose to replace, say for example, one value factor with a better value factor, but we go through a model review process. So that has to be vetted by the investment committee, and only then any change. So there is a discipline to the way the model works, but it's definitely not a static model, so we do intend to keep it evolving over time to, in that sense.
Right. Right. So just a small extension to the same point that you were mentioning. So any quant fund manager or any quant strategy's basic advantage is the fact that at all points in time there is no emotion into the picture. So even during points of time where the strategy is not doing well, while there is an inherent urge to override the model, the fact that there is no fund manager will imply that it will stay pure to the rules. Now, once we also bring in the additional layer that the model also has to evolve, there is also this inherent conflict that at some point in time when it is underperforming, we might misconstrue a temporary short-term underperformance to be a problem with the factor, and we might think it is getting adapted or evolved, and we might also override the model without really intending to override the model. So how will you address this issue that probably it's more of a very subtle issue that might crop up at some point in terms of, am I overriding the model, or is it just a natural way of improving the model? How would you address this issue in the future?
Yeah, so essentially, any factor before it gets chosen goes through very rigorous, very long-term sort of testing in that sense. So the factor has to be one, academically sound. So we will not just randomly take any data which happens to be in vogue. So it has to be academically proven, which means there has to be either some risk-adjusted returns or some behavioral reasons for that factor to continue to exhibit alpha over time. So that is extremely. So any factor that we select has to tick off all these things. Then we'll test it in the Indian context over like 15-20 years of data, and we do something called in-sample, out-sample testing. So we'll test the factor over a shorter like part of the data set, and then see, that's called in-sample, and then we'll also see whether the same, and then we'll apply that factor on the out-sample. So it has to work both in the in-sample as well as the out-sample data. Also, it has to show, so we look at rolling alpha over time. Then we'll see how true that factor has been to its characteristic. Like, if it's, for example, a cyclical factor, we'll test really how it performed in an up cycle and down cycle. So it has to go through a lot of rigorous tests before we can, conclude that this is a good factor, this is a factor which merits inclusion in the model or not. And therefore, we've got the discipline of the investment committee, where say me or my team members cannot independently do anything. We need to present a case, present the data to a larger group, which will be responsible for deciding. So that's how the governance around the entire model is also designed.
Sure. So for somebody who's looking at this particular strategy, how should somebody define underperformance and define outperform? What's a good performance and when is it a bad performance?
Yeah. So whatever work that we have done, and we've been quite conservative, with our estimates of impact costs, and very realistic with the way we try to simulate the performance of this. And in fact, we've been very conservative with the kind of our research and what we've told investors is that over a medium term, which ideally would be a 5-year plus time horizon, we've seen that there's a the model has been able to deliver 3 to 4% of annualized excess return over and above the benchmark. Also, on a rolling 3-year basis, at any point of time, if you came in, an investor would have had a positive alpha when they go out. So these are the data points essentially that we have, which we believe is a comfortable or reasonable expectation which any investor can have. That being said, any model, and for that matter, any active strategy is not going to be outperforming all the time. So there will be obviously periods of outperformance and periods of underperformance. What we try to do also in our presentations is we try to outline periods where we believe the fund is more likely to underperform, because it's follow the model, so it's much more predictable in that sense. So typically, because it has a very strong elimination and quality is a very important factor, tends to outperform in more defensive markets, which is also kind of what the data shows since the time it was launched. And also, however, in very exuberant market conditions, where sort of price behavior is not necessarily following fundamentals, in such periods, it is possible that the model may, for some bit, underperform the index also. Also, sometimes when there's a very unpredicted regulatory change, say something like a recapitalization of PSU banks or something like that, temporarily, the fund may underperform because it may not be owning some of those names which were specifically impacted by the regulations. So over a cycle, by kind of trying to protect to some extent in weak markets, and largely trying to capture most of the up cycles, we've seen that it lends more stability and ability to sort of generate that kind of a performance over time. That's what we've even seen so far, since of course it's not been a very long time, but even the live strategy has kind of done in line with expectations as outlined.
Sure. So the other question is, now you have a unique ringside view where you have a lot of active managers also sitting within the same fund house, and you also have a quant strategy running. Now, if you really look at active fund managers, obviously they also have an underlying rule-based process, but the only difference being on top of it, they layer their discretion. So, as somebody who has seen both these strategies at the same place, what do you think would be the advantage of human discretion, and where do you think will be the disadvantage of human discretion?
Yeah, no, that's true. See, because the model is run independently by the quant research team, we are not part of the investment team. So therefore, it is completely independent of the investment team, and it's there right now. Also, if you see, there will be stocks which are maybe owned by our active fund managers, which are not sort of selected by the model, and vice versa. And that's perfectly fine. So the point is that on active funds, one of the benefits of that is that they may be able to buy stocks or whatever. They may be able to own stocks basis some kind of a turnaround, or some kind of a view on some future event which is not necessarily reflected in the data, and that's not something the model does, because the model just goes by the data. It does not really look into any narrative or something. So that is one advantage, you can say, of the active fund management vis-a-vis the model. But on the other hand, the model doesn't have any human biases. So that's the strength of the model also, because active fund managers, however good they are, at times they tend to, they tend to underperform their own sort of frameworks because of the human bias that comes into play, which the model will never do because it doesn't have any human bias in that sense. So there are pros and cons. I think one benefit of the model, I would say, is it's very transparent and predictable. So you know what the model is going to do. So in that sense, it's very predictable the kind of stocks it would pick and the kind of portfolio that will be constructed. So an investor would not really tend to be surprised that much because they already know what the model is going to do. In the active fund manager, you rely more on the ability of the fund manager, and human beings are a lot less predictable, in that sense, which can be working for good or bad. I mean, it could work both ways. So that's I would say, pros and cons of both.
Right. So, Aparna, you also mentioned something very interesting that at some points in time, there will be stocks which are eliminated by the quant model, but are at the same time chosen by a particular active fund manager, probably in your stable itself. Now, in those cases, it might have some meaning in the sense that there is something that the discretion or the discretionary fund manager is able to see. There might be a nuance which the quantitative model is missing, or it might be the other way around, that there is a bias getting built and he's not seeing it as dispassionately as the quant. So when something like this happens, how do you view, or not how do you view this, but does it go into an input for both the active fund manager and for you? For you, it might be a chance to improve your process, or it might be also a double check for the active fund manager that am I getting biased? So do you guys use this internally to improve your process?
So, I mean, we obviously know what our portfolios are all in the public domain. So even you as an investor will know what is there in our active portfolios, and as but we operate very independently. So yeah, of course, the active managers they can see the portfolios of the quant fund and all, but and we cannot get colored by what they do because it's purely there's a model, right? There's a model and it just rebalanced twice a year. So that way they run very independently of each other, and so it happens, but that's what it is. It's like they see that some XYZ AMC has got some stocks which they don't have, or vice versa. So it operates like that. So for them they will have to just be actually for them they need to keep on reviewing their own portfolios for their own outperformers and underperformers. And for us also, as a quant research team, anyway, we are, as I said, we do a lot of research to see what is happening in the factor space globally. What is the experience on factors, and we do a lot of reading and testing. So those essentially work like parallel processes, you can say.
Right. So, Aparna, recently there was an interesting tweet which I saw somewhere. It said that there's never a back test which fails. So, in essence, what happens is that we only get to see the final back test which actually performs. So, all the back tests where the outcome was not great is never shown to the outside world. So, in that sense, when you are running these back tests, how do you make sure that there's no survivorship bias, or probably the issue of overfitting of data? So how do you ensure that the backtest kind of doesn't get into these kind of traps?
Yeah, no. So more than showing to the external world, frankly speaking, the backtest is our way of making sure the strategy is robust. There's no other way, right? Because ultimately you have to see if the strategy would have worked on historical data. Like I said, the backtesting actually is much abused. I have seen myself, but it is. If you ask me genuinely, there's nothing as powerful as backtesting, which helps you to see the blind spots in your own strategy. Even when you look at fighter pilots and astronauts, they will not actually, I mean, they go through that simulation process before they actually fly those vehicles or whatever, because so back testing is supposed to be done using certain principles, like you said, for example, survivorship. So what we do is we don't test a back test. We did not do a back test on only a static data set, right? So we actually, for example, looked at the BSE 200 over the last 15 years. We looked at it and we applied it on the constituents as they were in the past to avoid this survivorship bias. Then what we did was, we tried to go as much far back in history as possible, so that you're not trying to do a back test just using like 5 years data, because that's not good enough, essentially. If we could go back even further, we would have gone back even further. But in India, you don't get data beyond. So that's why whatever we did, we made sure it is backed by academic research, and it has worked in other geographies and other asset classes in other markets as well, to give us that comfort that yes, this is something which is sound. Then what we did was in sample and out sample testing. So whatever time period that we had, we built the model on like 2/3 of the data. That's called in sample. And then we applied the same model. So the model was essentially trained only on a part of the available data set. And then we verified whether, that would also have worked in a out sample data set, So we did all this type. So, and then we tried to be realistic about impact costs, because many times, if you don't accurately consider impact costs, your strategy in the backtest will always look much better. But when you factor in fees and expenses and buying, selling, whatever, there is a huge leakage. So we factored in a pretty conservative estimate of the impact cost as well, and that gave us a better sense of the robustness of the strategy, as well as gave us a better flavor of in what type of market conditions it will do better versus not. So, so that's how really we approach the entire methodology of back testing, and try to sort of make sure that the model is robust enough. Because otherwise, you're just going by your hunches. If you're not going to, if you're not going to look back in some form or fashion, then you are completely relying on your hunches. For example, a new fund manager, 3 years in the system, with only limited limited window of experience, you have to look beyond that. And there is no you have to essentially do back testing properly, if you don't want to just go by your hunches and be limited by your experience. So it is a very we don't do anything with back tests. I mean, very honestly, we find them to be one of the most useful tools which help you to realize your own blind spots. So we realize, oh, we thought this, but actually we were wrong, and the back test will tell you why, essentially.
Right. Also, just a little curious. So, is there a backtest that you ran for the inverse of your strategy, where you just did the opposite, and does it over a long period of time underperform dramatically? Just a thought.
So, particularly, in fact, we put it in our presentation on the elimination criteria, particularly. So we looked at those different elimination baskets. So basically, the part which we remove from the portfolio, eliminate from the portfolio, and if you see that that has eroded value, so it has underperformed the BSE 200 very materially. So, for example, just avoiding some of those names was actually, we could see that it was a very rich source of alpha. While it will do, there'll be periods when even that eliminated basket will do well, but over longer periods of time, we've seen that in fact some of the eliminated baskets even did worse than like FDs. So we did do that backtest. Even our forensic criteria, we have backtested those, and in fact, we saw that over a period of time, they have actually delivered negative returns, the eliminated baskets. So yeah, and even our factors, like why we've not looked at, say, a long short, something of that sort, but we would look into it maybe, and some of the factors are mirrors of, so we have a method by which we measure factor crowding. So there we look at, say, how a factor has done versus its mirror image, the anti-factor, so we do some of those, we measure some of those things also. It even helps us to determine if a factor is getting too crowded, or if the valuations are becoming very out of whack with reality. It helps us to determine some of these aspects as well.
Right. Also, Aparna, considering the fact that we're all going through, though it's cliched, very unprecedented event that's happening, and the key part is a lot of business models might have to completely change in the future, and a lot of them might also get disrupted. So, in that sense, the argument might be that the past of whatever pre-COVID might be completely different for a certain group of companies compared to post-COVID. So when you're building a quant model, obviously it is predominantly built on what happened in the past. So in that sense, how would you look at a quant model which is probably going through a period where it might possibly be a regime change for a lot of companies? So how does somebody think through this issue in the lens of a pure quant model?
See, there, like you said, but there have been sort of unprecedented events even in the past. So if I just look at the Indian context, maybe a demonetization or a Lehman Brothers type of an event, or a Euro crisis, while it may not be as severe as COVID, but there have always been different unprecedented shocks in the past. If you go back to other markets like US and all, they went through 1987, and so, or the bubble, the tech .com bubble. So there are always some or the other unprecedented events. So what we try to do is, one is, of course, keep it multi-factor. So we're not trying to depend on only one regime. Markets always work in cycles, right? Even COVID, you can characterize your post-COVID as maybe you can characterize it as recession or something like that. So what we try to do is we've tried to use a multi-factor approach to the portfolio construction. So we're not relying on only one factor. We are relying on a combination of cyclical and defensive factors. Making our endeavor is to make it more delinked essentially to the market cycle, and trying to have a more consistent performance. And also we apply very stringent risk management, because again, you don't know how for one particular company what will happen. It's possible that one company or few companies may get disrupted. So for that, you have to be very cognizant of risk. That is why we have very stringent rules on concentration, active sector. This is very important, sector concentration, because we are trying to capture the top companies within all the sectors, or at least whatever is possible to be selected. So by not straying too far from the sector construct, part of this risk that you're talking about does get addressed, because we're essentially and again, when you rebalance, you're linking it to the weight in the underlying index. So to some extent, you are relying on, and the index weights itself move, as the profit shares, as the market caps of these companies move. So you're respecting that element of it. So by putting in all these constraints, sector constraints, liquidity constraints, linkages with the market caps via the benchmark weights, etc., we try to manage this risk, and having a very well diversified portfolio is how we try to manage these risks over as we move along.
Sure. So, Aparna, while the space has relatively been this is almost a nascent space in India. While it's, but when you look at it from a global front, obviously it has a lot more time frames across which these strategies have been deployed. And so how does it work, and how has it evolved across the developed markets?
So in the developed markets, particularly US, there's a plethora of, frankly, investment options, not just in the factor space, but there's so many others as well. So these type of the factor or the smart beta strategies, they've grown much faster essentially than the normal active and even for that matter passive over the last 20-30 years. What we read is that these factor strategies are estimated to be having an AUM upwards of $2 trillion US dollars. And they're of different, they're a combination of single factor or multi-factor, or, it's not just like one, but it falls in that broad bucket of factor-based strategies. So it's estimated that the AUM managed on such strategies will cross 3.5 trillion USD by 2022, making them very sizable. And as investors have as basically the alpha in the large cap space has diminished over time, and people want alternatives. Investors want alternatives to plain passive, like market cap weighted indices, and they are searching for more, lower cost solutions or lower cost alternatives. That these have resulted in these kind of smart beta factor strategies have grown, in other markets over time. So we believe that similar should happen or can very likely to happen in India as well.
Right. So, now one final question. So, for any investor, let's say, who's interested to explore and read more about the whole world of quant investing, are there any interesting books or blogs or websites that you would want our readers to explore?
So there are a lot. I mean, there are a lot of there are lots of research papers. I mean, there are a lot of like AQR is one which does pure quant work. There's a plethora of academic literature on on factors, like all the way from Pharma and French. You'll find papers by multiple Nobel Prize winning teams. So there's a plethora of, even we have, if you go to even BlackRock's website, you will find there's a dedicated section on factor understanding, factor research. Even we have tried to publish several papers which are more India specific. Like we've essentially applied that research to India, and we've tried to share that with the with the investors or the readers who want to. So there's no end to actually the amount of literature which is available in the factor investing space.
Thank you so much, Aparna, for all those insights, and we really appreciate your time.
Thank you so much. Yeah, thank you.
Thanks, Aparna.